Welcome to DSP Chart Economics webinar. Today's webinar topic is consolidated versus aggregated financial statements for tax groups and UAE corporate tax. So in the interest of everyone's time, we can get started. So I'll now hand over the session to Mr. Satya. Before we begin, please note that if you have any questions related to today's topic, feel free to post them in the chat. So we'll do our best to address all your questions during the webinar. Thank you, everyone. And hand over to Satya.
Thank you, Sunil. Good morning, everyone. Thanks for joining the session. I'll share my screen now. Hope my screen is visible.
Yes, we can see you.
Okay, fine. I'm sure most of us are already familiar with the way how you do the consolidated financial statements IFRS 10, and the day one IFRS 3 business combination followed by IFRS 10 for the subsequent presentation. Today, our focus is the discussion. We will be beginning with the conditions. This must be aware by everyone. Tax group basic conditions, a quick recap of the requirements. Then what are the major changes that have effective from 1st of January 2025 and for the later periods? And will be the first step one is preparing the standalone financial statements we call SFS of the tax group members. Then the AFS journey begins. What are all the things that we need to do? And then the exceptions, the 5 exceptions, exception 1, 2, 3, 4, 5. So these are the major exceptions while preparing the aggregated financial statements compared to the consolidated financial statements. So these are the 5 exceptions we will discuss in detail. And then for the companies or the entities that are exiting the tax group, post exiting, how their financial statements looks like. So this would be the conclusion, one last discussion, followed by how the financial statements, what are all the components? Like in the CFS, we prepare P&L, statement of changes in equity, OCI, balance sheet, and multiple. So what are all the elements, financial elements we need to prepare for the sake of corporate tax? And then the final, how the audit report looks like. What are the components of the audit report? In what way it has a deviation from the international standards of auditing? So this is the agenda of our discussion. We will start with the basics, a quick recap of the tax group. Component, the conditions for creating a tax group. I'm sure this is pretty well aware by everyone, but then a quick recap of parent company, a parent entity, and subsidiary entities, be it one or multiple like subsidiary entity 2. All of these companies can form a tax group when they comply with certain conditions. The condition 1, the parent entity directly or indirectly should hold more than 95%, or equal to 95% of the share capital plus voting rights, and should be entitled to the profits and net assets. Condition number 1. And condition number 2, they should have the same accounting standard. They should follow the same accounting standards, be it IFRS or IFRS for SMEs, but all the group companies should have the same accounting standards. They all should follow the same financial year. But in addition, if you see FTA decision number 7, FTA decision number had one more additional requirement. All such assets, all such companies should have a common or a uniform accounting policies. What do I mean by this? Measuring or subsequently measuring its investment property at cost method. The subsidiary entity also have the same accounting policy, meaning investment property should be having subsequently measured at cost, not at the fair value. Fair value is not error. So all the group members should also have the same time period. So this we don't see in the UAE corporate tax law, but this is a requirement as per the FTA edition number 7. Following. And none of the companies should be a qualifying free zone person. None of them should be an exempted person. So once we fulfill all the conditions, and the conditions has to be throughout the tax period, meaning from the 1st of January or whatever the tax period beginning date till the 31st of December, not just for a part. Once we comply, we can put up an application to the FTA. Once they approve, there is a tax group created. Let's assume there is a tax group with the members. There is a tax group created with the members of parent entity, subsidiary 1 and subsidiary 2. So what is the benefit? We will ignore the transactions that are carried. So intra-group transactions, balances, all the transactions between intra-group will be ignored. Number one, the first benefit. The second, there will be only single TRN, so only one corporate tax return filed. Number three, the transfer pricing is not applicable with exceptions. So this is also having an exception. I'm saying in general, transfer pricing can be ignored to an extent of the transactions carried between these group entities. However, with a 4 exceptions are given when transfer pricing still applicable. So there are multiple benefits that the tax group can enjoy. Now let's take a scenario. The parent entity has newly acquired another company, subsidiary 3, and which is a loss-making company. So all the years, like in 2024, there is a decent amount of loss. In 2025, on 1st of January 2025, assuming parent entity acquired this new subsidiary, subsidiary number 3, and it want to be join the tax group. Say, for example, it has been admitted as a tax group member. So now we have S3 also in tax. Can the carry forward losses, the losses of 2024, can that be carry forward? I would like to have your answers. You mention yes or not possible. I repeat the question. If subsidiary 3, a new entity which have incurred a loss in 2024, now in 2025 joining the group tax group, do you think the carry forward losses can be enjoyed further, or it has been completely lapsed? Okay. No. Okay. Many are not allowed pre-grouping tax losses. For the benefit of them, carry forward tax losses now become the tax losses of the group. Tax group can carry forward the losses. However, the limitation that the losses can be only enjoyed by the taxable income attributable to S3, meaning the tax losses cannot be enjoyed by the other members of the group. We have to identify it separately, the subsidiary 3's profit only to the tune we can use it, otherwise not. Okay. Another scenario wherein from the group, subsidiary 2 want to exit. Subsidiary 2 want to exit and assume there are some losses before just exiting of subsidiary 2. There is a loss carry forward by the tax group. Now tax group has only 2 members. One, the parent entity in S1, S2 is now out of the tax group. Before, when they were together, there is a losses to carry forward. Whom do you think can carry forward this loss? Is it subsidiary 2 or parent entity or proportionately? I repeat the question. There was a tax group which was into losses. Because of some reason, one of the member want to exit the tax group. Okay, proportionate. So one of the members want to exit the tax group. Yes, the losses can be carried forward only by the parent entity or the group in which the parent entity is still exiting, not the one who is exiting. The company which is exiting cannot carry forward any losses, although independently the entire losses belonging to S2, still it cannot carry forward. It can be it is an asset of the parent entity. Okay. Now, who is responsible for paying the taxes in the tax group? Who is responsible? The parent entity is responsible for the compliances, only for the compliances. Be it, for example, if they want to prevent clarification, who has to submit? It's the parent entity which will submit. If they want an advance pricing arrangement, or if they want to have any return filing, so all the compliances to be taken care by the parent entity. However, liability is on everyone, joint plus several liability. liability of corporate tax is on all the companies, not proportionate. FTA can just take the entire amount from only parent entity or subsidiary one or subsidiary. They can choose one and they can take the entire amount from one company. So liability is joint and several. These are very basics which we know from last 3 years. Now then, what is the changes that have been happened from first of January 2020? So let us take a scenario. The financial years which are commencing before 1st of January 2025. For example, financial year 2024. Now we'll take another scenario where the financial years which are commencing on or after 1st of January 2025. For example, FY 25, 26, what's. So what are the changes? Previously, for FY 24, we should have gone for any kind of guidance. We have to refer ministerial decision number 125 of 2023. Now we have to go refer ministerial decision number 301 of 2024. What is the difference? So there are a decent amount of changes between these two ministerial decisions, but not very substantive. But yes, it is worthwhile. We have to go through the 301 and understand the differences that they brought in. So ministerial decision number 125 got repealed effective from 1st of January 2025. So there are changes. Yes. Number 2, do we need to create previously SFS standalone financial statements of each tax group member is not at all a requirement. Whether we create it or not, it's up to us. But now standalone financial statements of each tax group member should be prepared. Should be prepared. Can please mute. Standalone financial statements should be prepared as per IFRS or IFRS for SMEs. So these are further change. Next, previously CFS is mandatory that it has to be prepared as per IFRS 10. This is mandatory that we have to get it done. Now AFS we will prepare. It's mandatory, but not as per IFRS 10, but from the special framework of FTA as given by the FTA. Another scenario, audit of standalone financial statements not required, even though the independently a tax group member is doing more than 50 million. Even in that case, there is no need for the audit. Even now the same scenario, audit of SF is not at all required. Only we require the books to be prepared. No audit is required, even though it is doing independently more than 50 million. And earlier, before 1st of January 2025, audit of CFS is required only if it is doing a revenue of more than 50 million. But now audit of AFS aggregated financial statement is mandatory irrespective of the size of the revenue. So we don't even look at the revenue. The moment there is a tax group, they have to prepare AFS and this has to get audited. Okay. So these are the major changes shift over effective from 1st of January 2025. Now the question. Okay, last year I prepared SFS. By preparing SFS, I have shown 2023 and 2024 and 2023 as my comparators. Now I'm preparing AFS. AFS for 2025. Do I need to rebuild my 2024 or can I show the same numbers of CFS? No, you have to redo as per the special framework, the comparatives. So they want us to show the of course, it is not very clearly written, but then they have mentioned simply, you need to have the comparatives from the first day of the tax group. Unless the tax group is the first year. So from the first year of the tax group, they have to have, say, for example, a company, a group has a tax group in 2024. In 2025, you are preparing as per AFS special framework. You need to redo the 2024 as per the FTF framework. You have to prepare the AFS for 2024 as well. Comparatives are required, not just the CFS which was prepared previously. This will go for a change. So these are one thing, not very clearly written, but this an interpretative understanding. So AFS we need to prepare both for 25 and 24 as a comparative, provided if the group is already there in existence from 2024 or 2023. Clear? Can we go forward? Any questions so far? Can the 2024 comparative figures be unaudited? Unaudited in the sense like if they mention, they will be mentioning as unaudited only, most likely, unless we pay for both the years. If it is unaudited, again, it will become a qualification also. Okay. Preferably to get the audited, not to get any kind of qualification. Step 1, we have now started discussing about the requirements for the AFS. So far, we have just seen only the basics. Our journey will end the moment we complete the aggregated financial statements. What do you think? The step 1, is it SFS of the tax group members or the CFS of the tax group members? First, I will prepare the consolidated financial statements and then do adjustments, and then I will arrive at the AFS. Or do you think first we have to prepare the standalone financial statements and do the aggregation and arrive at the aggregated financial statements? So the approach is quite clear. We have to take SFS and then move on to the AFS. So this is not the approach. When we are preparing SFS, these are the important things what we have to keep in mind. Number 1, anyways, we will be preparing the financials in AED. We are required to prepare the financials in AED. And as per the conditions, we are required to have the same financial year for all the tax group members. Standalone financial statements should have the same financial year, should follow the same accounting policies. I mentioned clearly previously, I was mentioning very particularly, you have to make sure the subsequent measurements are the same. If the fair value through OCI is followed, it should be followed by all the companies. And they have to follow the same IFRS or IFRS for SME, same accounting standards. Now there is a question. There is a group which has a parent entity and 10 subsidiaries. It has 10 subsidiaries, out of which 2 are qualifying free zone persons and 8 are your regular free zone mainland entities and eligible for the tax group member. So what this group has done, they created a tax group among parent entity and the 8 mainland entities which are eligible. So there is a tax group created. Separately, they are maintaining for the 2 qualifying free zone persons, SFS. So going forward, they may be preparing a CFS, consolidated financial statements, for the purpose of IFRS, for the sake of commercial companies law, or maybe for the sake of any other law, but then only for the corporate tax, only for the corporate, they need to prepare the AFS. In AFS, they will include only the tax group members. They will not even touch, they will not aggregate the non-tax group members. So going forward, all our discussion, whenever we say aggregation, we are talking about only the tax group members. The non-tax group members, non-tax group subsidiaries, this is joint ventures or associates, we are not even discussing, not taken for the aggregation. Hope I'm clear. Okay. So the SFS will be prepared as per the AED, same financial year and everything will be completed. Now, when you have the investment in non-tax group members, be it a subsidiary, be it a joint venture or an associate. So how do we generally carry them in our standalone financial statements? We have 3 choices. Subsidiaries, joint venture, associates. You can either go by the cost method, or you can subsequently measure them at the fair value as per IFRS 9, or you can also follow the equity method, IAS 28. But when you are preparing the AFS, so for the sake of AFS, you are preparing SFS. AFS, you have to prepare only on the cost method. You cannot follow the fair value method, equity method. Am I clear? I'm talking about non-tax group members. For example, these 2 qualifying free zone persons, if there is an investment, we cannot fair value it, or equity method we cannot follow. So better to do it at the SFS level itself. Hope I'm clear. Any questions on this? SFS of group members and then aggregations, correct. Then, more importantly, no adjustments because of IFRS 3 or IFRS 10. No adjustment should be taken place in standalone financials. Question 1. IFRS 3, IFRS 10, what are all the adjustments that are being advised or given in IFRS 3 and IFRS 10? Is it implied on SFS or we use these standards for CFS, consolidated financial statements or standalone financial statements? Any adjustments given in IFRS 3 and 10, should we consider them while preparing SFS or CFS? Only for CFS. However, FTA went ahead, a step ahead. They also making it clearly, even by mistake, any of the IFRS 3 adjustments or IFRS 10 requirements should not be shown in the SFS. SFS should be completely having no implication from the IFRS 3 and 10, although it is not there, but then they want to make sure it should not be there. Clear? It should be in AED, same financial year and all accounting policies. Clear so far? So this is how we'll prepare the SFS. Clear, straightforward. Only thing we should keep in mind is if we have any investment in non-tax group member subsidiaries, make sure you follow the cost method only. In general, for example, if you are following equity method, you cannot follow that. Fair value method, you cannot follow. Prepare a separate set of financials only for the sake of corporate tax. But it is very less likely that any of the adjustments of IFRS 3 or 10 will fall under SFS, but very, very few exceptions. Step up. There are in US GAAP, there are some provisions that can make even that can impact even the SFS also when there is a business combination. So to avoid any such scenarios, they have very clearly mentioned. Okay. Then this journey begin. Starting the IFRS, we will just follow the principles or the guidance given in the IFRS 10, just like the way how we prepare the consolidated financial statements. Almost all the principles we will keep in mind, except few. So we will discuss those exceptions also. Before that, when we prepare IFRS 10, what we will be doing, we will do the line by line consolidation. Line by line consolidation we will be doing all the group members, parent entity plus subsidiary 1, subsidiary 2. We will take the P&L balance sheet line by line. We will do the consolidation and we will do some eliminations. So when you are doing the line by line consolidation, we have to do exactly like the way we do in the consolidated financial. Exception point number 3. So this point number 2 we are discussing. So when you are doing the consolidation, there is an exception which we should not do the consolidation. We will discuss in the point number 3 coming from. What is our next thing we will do? Do the eliminations. What kind of eliminations we will do? Can I have some understanding? When you are preparing the CFS, what kind of transactions we will eliminate? Can I have some pointers? Investments in subsidiaries, okay. Okay, intercompany balances. Intercompany purchase, so any incomes, expenses. Someone mentioned intercompany purchase or sale. So intercompany purchase or sale, we will eliminate, but if only there is a stock available. So meaning unsold stock, we will recognize unrealized gains and losses. Incomes and expenses we will eliminate. Anything more? Equity of the equity share capital of the subsidiary we will eliminate. Anything more? Any valuation adjustments? Say for example, parent entity has given a loan to subsidiary. This loan we will eliminate. On top of it, say for example, parent entity has created some provision, expected credit loss, some value adjustments, value allowance it has been created. Even the value allowance or ECL or provisions, this will also be eliminated. Anything more? Okay, let me give one more example. Parent entity sold an asset subsidiary. Okay, so it was sold for parent entity has a carrying value of 100 and this was sold to the subsidiary at 120. Will you eliminate
Satyaji, you are not sharing your screen.
Okay. Sorry. So I just listed down one of the pointers that we have discussed. Eliminations, the investment in the subsidiary will eliminate, the intercompany balances will eliminate, any intra-group income and expenses transactions will eliminate. If there is a trading happen and the stock is still lying with the group, to that extent, the unrealized gains and losses will eliminate. Equity share capital of the subsidiary will eliminate, and we will create, of course, we'll create a non-controlling interest. And value elements we just have seen. Now we are talking about another one, change in the value of assets and liabilities. Discussing like parent entity sold to subsidiary an asset whose carrying amount is 100, sold to subsidiary at 120. So these 20 dirhams we will eliminate, number one. In the CFS, we will record the asset value only as 100. Hope you all agree with me. What more I need to do apart from this? For example, if subsidiary is taking depreciation of 10%, do I need to allot 12 or should I take only 10? 12 or 10? Audio not clear? Am I clear now? Someone please confirm if my audio is clear. Is this good now? Audio is breaking. How about now? Is this fine? Sunil, can you hear me well?
I can hear you. Maybe they are facing some issues. For the meantime, can you turn off
It's
your
fine.
video list for
Okay. 1 second. Hope this is good now. So let me know if there's any kind of issue in the audio now going forward. We will be taking 10, meaning that asset or liability change because of a gain or loss. So multiple adjustments we will do while preparing the CFS. For AFS, we will be considering, yes, income and expenses should be eliminated. Correct. Unrealized gains and losses should be eliminated. Intercompany balances we will eliminate for preparing the AFS. Valuation allowances, all these adjustments we do just like how we do in the CFS, but not the investment in subsidiaries. We will not eliminate. Equity share capital of the subsidiary we will not eliminate. We will still aggregate. We will still mention in the aggregated financial statements. NCA, the concept itself won't be there. We will not create. Of course, maybe 5% or less would be the NCA, non-controlling interest. Still, even this will not be presented in the AFS. So how it will be built, we'll be going. We'll see it forward. So apart from this, just like other important conditions we need to keep in mind, same how we have mentioned, any investments in non-tax group members, be it a subsidiary, be it a joint venture, be it associate, should only be at the cost model. We cannot do the equity method or fair value method. All tax group members should have the same accounting policies, same financial year, and same standards, IFRS or IFRS or SMs, either of it they have to follow. Clear. And then they also mentioned no IFRS 3 or 10 adjustments. No IFRS 3 or 10 adjustments. We will see one by one. Exception by exception, we will see. We'll start with the first one. When you are doing the consolidation of the P&L, we will add up everything except one. So we started preparing the first step one. I prepared P&L of SFS, A and B, ALLC and BLLC, which are part of the tax group. Now I'm preparing the AFS, aggregated financial statements. So if there is a revenue 100, I will just simply add line by line. Likewise, cost of goods sold, expenses and everything I will add line by line. We have arrived at profit before tax, less tax expense. In the tax expense, I have current tax and deferred tax. I arrived at profit after tax. This is how we present for the CFS. But then for AFS, till this portion is okay. Till this portion, you are okay. You can do the line by line consolidation, line by line aggregation, less eliminations. Like if there is any income between intra-group transactions, you eliminate. Good to go. But this portion, you be careful. When you are trying to consolidate or aggregate the tax group or tax expenses, first remove from that any UAE corporate tax related expenses, be it current tax or deferred tax that pertaining to the UAE corporate tax. First eliminate. Only the balance taxes you can do the consolidation. You can do the aggregation. What are the balance taxes? Be it a foreign tax, be it a foreign withholding tax, or be it a emirate level taxation. These items you can just aggregate and you can show, but not the UAE corporate tax. So in AFS, how they want us to present, you do the complete aggregation till profit before tax. After this, you can still show the tax expense only like tax expense for non-UAE city. You show something like this and you show profit after non-UAE corporate tax. So this is how they want to present. The purpose is to identify the taxable income. So I want this kind of present. This is the presentation the FTI is looking from us. Maybe later you can show after this less UAE corporate tax and then amount the profit after tax that can be given to the shareholders. You can present this way. But then this is one layer, an additional layer they want us to create, bifurcating between the other taxes and UAE corporate tax. Clear? So this is the exception number one. Any questions on this? What about top of tax elimination? No, only UAE corporate tax. Rest everything you have to be clubbing under non-UAE corporate tax. As of now, that is how the framework they have given. Okay, if possible, increase your volume. Okay, I'll speak louder. Better now. Fine. Then exception number, the next exception. This is quite simple. Let me understand from your side. A LLC, there's a company B LLC. They were not related in 2024. They were not related. A LLC has given a loan to B LLC, say 100,000. Okay, so A LLC preparing a balance sheet. On its asset side, it is showing a loan receivable of 100,000. Okay, B LLC has its loan payable 100,000 has been recorded. Later, after 6 months or 8 months, ALLC thought, okay, there is an impairment, ECL, expected credit loss have been created against this loan, 20,000, and it is showing only 80,000 as a loan receivable. On 31st December 2024, there is an expected credit loss created, and they are presenting net loan receivable as 80,000. So this 20,000, they are not related. As on the day, as of 31st of December, they are not related to each other. There is no tax group among them. This 20,000, can it be deductible? Can it be claimed as a deductible loss by ALLC? BLLC has not made any kind of change in its books. As per the BLLC, the loan payable is intact. So do you think this is a deductible loss? Of course it is deductible loss. Now things got changed on 1st of January 2025 because of some reasons. ALLC has acquired BLLC. Right? On this date, ALLC still opening balance is same. The loan receivable is 100,000, and then there is an expected credit loss of 20,000 and 80,000. These are CFS. BLLC loan payable still showing us 100,000, but then they formed a tax group. Okay, can someone tell me how the CFS should looks like, sir? I will talk about AFS. But can someone tell me in the consolidated financial statements on 1st of January 2025, meaning I have to apply IFRS 3 business combination principles, how I present this loan receivable and loan payable? Do I need to eliminate or do I need to do anything? Practical example of non-UAE corporate tax is, as I mentioned, any foreign taxes paid in the foreign jurisdiction, taxes paid in foreign jurisdiction, any emirate level taxation. Need not eliminate. So IFRS 3 says, I don't care what your books are showing. This is your carrying amount. Your 100,000 is carrying amount. For me, I will go with the acquisition method. I will take only the fair values. You have to present, say, for example, if the fair value in the business combination process, they identified the fair value of this liabilities as 80,000, then you will be keeping 80,000 and you will eliminate. So for the CFS, it works completely different. They only go by, they don't even care what is the valuation elements. Completely, they will keep everything aside and they will see only the fair values. Coming to the AFS, they want us to mention everything. Don't remove, don't eliminate. Loan payable, let the 100,000 be presented. Loan receivable, let the 100,000 be presented and the expected credit loss be continued. 80,000, 20,000 and you show 80,000. So don't do any kind of elimination which are though required for the CFS. This comes only if one of the group member enjoyed a deduction first and later they both became a tax group members. So it's like a tax planning tool, otherwise they take it. So they want us to make sure this loan and this payable should be as it is, should be shown, no netting of the 100%, the full amount should be presented. Fine. So no elimination of losses or expenses claimed pre-tax grouping. We'll go talk about the next deviation. One simple thing, no goodwill, no gain on bargain purchase, no fair value of the step. In case of step acquisition, there will be fair value adjustments. Nothing should be presented in the AFS. Okay, let's take a very simple illustration. ALLC and we have BLLC, standalone financial statements. BLLC has a share capital of 10,000 and net assets of say 60,000 and retained earnings of 50,000. Net assets, let me talk it, PPE. PPE here, I don't want to, it's not a common group of assets, say multiple assets, varied range of assets, 60,000. So the deal goes like this. ALLC want to take over BLLC. And when it inquired, the market value, the fair value for this asset is say 80,000. But then BLLC owners is asking for a sale consideration of 85,000. Sale consideration 85,000. ALLC agreed for that and say, okay, fine, I'm willing to purchase this and investment in subsidiary 85,000. He paid 85,000 and he acquired, the ALLC has acquired the BLLC shares. Because of this reason, there is a business combination happening. In CFS, once there is a business combination, ALLC not required to prepare SFS. ALC will no more prepare standalone financial statements unless required by a law. Okay, but in UAE it is required by law, so we are preparing. Coming back, in CFS, how I will present, sir? Assuming this share capital is 850,000 to make things easy. I'm just showing the share capital is 85,000. We'll prepare the CFS. Share capital, how much I need to show? 85,000 or I had to add 85,000 from here and share capital 10,000 here. Should I need to show 95,000 or should I need to show 85,000? I'll repeat the whole question. ALLC want to acquire BLLC. So we open the balance sheet of the BLLC. There is a group of assets or a component of assets. 60,000 is the value. The fair value of the assets is 80,000, but the owner of the share, the BLLC, want a sale consideration of 85,000, which have been agreed by ALLC. And they paid the 85,000. Where they got the money? They have a share capital which was infused as a bank. They paid it. Now we are preparing the CFS. How much I need to show PPE? How much I need to show investment in subsidiary? How much I need to show the retained earnings? Can someone please tell me? Okay. I need to show 85,000. Perfect. Okay, I have shown 85,000 over here. 85,000 I have shown. PPE, how much I need to show? I will show at the fair value. 80,000. Investment in subsidiary will be eliminated. This investment subsidiary will be eliminated. Retained earnings will not be taken. Any retained earnings from the ALLC only be taken. Since in our illustration there is nothing, we will show it as 0. The balance will be recording as a goodwill, 5,000. Clear? But AFS, you cannot show the goodwill. Goodwill should not be presented on the AFS. So how we can eliminate this? How we can match the balance sheet? How we can match the balance sheet in this case? In the AFS, when goodwill should not be taken. So here comes the next exception, super most important exception. For the AFS, my friend, you should not even take, now I'm talking about the AFS. You should take the book value. What are the book value? Exact consolidation. Just add whatever line by line with no fair value adjustments. Just take the actual amount of carrying amount. 60,000 you present. Number 2, investments. Don't eliminate. Just bring as per the investment it is shown. Show 85,000 as it is. Yes, it's a duplication, but still you have to show present. Goodwill, don't show. We are hated against the goodwill, but gain on bargain purchase, not to record anything, make it 0. Share capital, show both of it, 85,000 plus 10,000. Together you show 95,000. Retained earnings, just bring it as it is. Show whatever 50,000. So this is how you will have 90 plus 50, you have 145K. And here you have 145K. This is how you need to do. No fair value adjustments of the PPE, number 1. So the deviation 1, fair value of the asset should not be taken the AFS, like the way how we take in the CFS. Number 2, we generally eliminate the investment in subsidiary for the CFS, but you cannot do that elimination in the AFS. Share capital of subsidiary, we eliminate, we ignore while preparing CFS, but you cannot ignore, you have to add up. You have to add up in the AFS. It's a complete gross up. Grossing up we have to do. Yes, there is a duplication, but still they want us to present only in this way. Sorry. Clear? Goodwill or bargain purchase, gain on bargain purchase, or any kind of fair value adjustments for the assets and liabilities should not be there on the AFS. Just line by line, add it and bring it and present over it. Clear? Okay. However, with one exception. One exception they have given. What was example you have seen? ALLC acquired BLLC. ALLC was having 85,000 of share capital and investment in subsidiary 85,000. BLLC, what was the numbers we have seen? Share capital of 10,000, retained earnings 60,000, 50,000 we have seen 50,000, and they have some assets worth of 60K. This have been fair valued at 80K, but then the agreed consideration was 85K. CFS we have prepared. Share capital, when you are preparing CFS as per IFRS 10, we will just only bring in the share capital 85K, and investment will be completely ignored, 0. Investment will be 0. From here, we will take the present value, the fair value, sorry, 80K, and the balance as goodwill 5K. But then we understand AFS does not entertain all that. For AFS, you have to consolidate everything. Share capital, make it 95K. Retained earnings show as it is 50K. PPE, exactly the book value. And then investment also you have to present 85. This is how we have given. But they have given an exception, in which case you can still continue the goodwill. You can still show the goodwill in the AFS also. If this transaction is the separate legal entity have been taken over by the ALLC. It's a separate legal entity have been acquired by the ALLC in the business combination. But there are scenarios. For example, the same situation I will take it. ALLC and BLLC are two independent companies. BLC is not it's not the ALC is not buying the shares of BLC, but BLC is selling an independent business. An independent business of a BLC is sold to ALC. So in the business combination, there is no separate legal entity acquisition, but an independent business. In such case, yes, go ahead and show the goodwill as well. How many of you want an example for this? Or you are good with this? What is the logic behind the duplication versus CT liability? So the logic is very simple. As you can see, they don't want any kind of goodwill. They don't want any kind of escalation of the PPE, unnecessary escalations, the fair value adjustments they don't want to do. So the only way out is just add line by line so that everything looks from the carrying amounts of the respective companies. So it will be more easy. The depreciation and everything will be taken at the carrying amounts. Okay, since no one is looking for the example, I'm just ignoring this one. Otherwise, the goodwill, there is an exception. The exception is if in the business combination, the acquisition is not a separate legal entity, but just an independent business. In that case, goodwill still be continued. Okay, if time permits, I'll take it in the last. We are done with this deviation. The last one, the last no, this is also we covered. No elimination of the investments in the TG members, the tax group members, investment and their share capital should be always grossed up, like the way how we have presented. So the investment should be shown, and the share capital should include the share capital of the equity of the subsidiary. We should not be ignoring this. Okay. And one last deviation we are discussing now. No elimination of the impairment of the investment in tax group subsidiary. The previous one, I'm just reiterating here. ALLC was having a investment in the subsidiary. This I'm talking about SFS. Investment in subsidiary, how much? 85,000. BLC has whatever, like has a share capital and all. Assuming in a scenario because of after business combination, after acquiring BLLC, ALC is not so happy. They thought, okay, let us do some kind of impairment. 15,000 dirhams of impairment they made in the SFS. They want to carry investment of 70,000 only. While preparing CFS, we completely ignore this will not be there. It has to be eliminated, be it investment in subsidiary, be it any kind of impairment losses or any fair value changes relating to the investment in the subsidiary. We should not even consider while preparing CFS. But our friend AFS don't want to eliminate. You have to show your investment of 85,000 and you continue to show your ECL or impairment loss 15,000. Don't delete anything. For CFS, maybe you're ignoring the whole thing, that anything pertaining to the investment subsidy you may be removing. But then for AFS, you have to show your investment plus any kind of losses, impairment losses that was carried in the SFS should be shown in the AFS also. Clear? So that is the next adjustment. A quick recap of what we have discussed so far. We started with the basics, understanding the conditions required for the tax group. This we know from 2023. Then we entered the discussion of effective from 1st of January 2025. What are all the changes? Prior to that, what are the requirements? Post 1st of January 2025, what are the requirements we have seen? Then we started the step number 1. Standalone financial statements of each tax group member to be prepared. On what basis it need to be prepared, we have discussed. Then we started working on the AFS. SFS is the step 1 for preparing the AFS. So we don't need to bother about CFS at all. SFS has to be prepared. But for AFS, there are certain requirements which we have seen in the second step number 2. We do very close like how we do the consolidation as per IFRS 10, IFRS 3, but then certain adjustments are given. Certain eliminations. When you are doing the consolidation or aggregation, you should not aggregate the tax expense. You cannot directly add up for the, or you cannot directly aggregate the tax expense from the SFS. You have to eliminate to the component of UAE corporate tax. And the presentation also, they have given a presentation how it need to be done. This is the first deviation. Deviation number 2. If there is any pre-tax group If one of the member enjoyed any deductions, then don't do any elimination relevant to that particular assets and liabilities. We have seen an example. Next deviation. In case of no goodwill or gain on bargain purchase or any fair value adjustments to be done, how we can achieve this? This can be achieved by including the investment in subsidiary. We will not eliminate the investment in subsidiary. We will not eliminate the equity of the share capital. We will bring as it is everything at the carrying amount, not at the fair values. So we have seen an example for this. And the last one we have just seen, in case of any impairment made on the investment in subsidiary should not be eliminated, which we generally eliminate for the CFS, we will not be eliminating. So these are the 5 adjustments or 5 deviations that we have to do from the IFRS table. Otherwise, rest of it more or less the same, meaning any intra-group income, expenses, intercompany balances, transactions, unrealized gains and losses, or valuation allowances, and change in the value of asset, everything should be eliminated, remove for the AFS as well, except these 5 deviations. Clear? So it's generally depreciation effect nullification for doing aggregation, even while eliminating the CFS. Yes, we will be eliminating depreciation on what? Now, the last one, we are talking about the investment in the subsidiary. So ECL on the investment in subsidiary, anyways, it's a participation exemption. We cannot get any kind of benefit. So they want us to eliminate here. Clear? Can we go for the last one? The FS, the member leaving the tax group. Before we discuss this, I want to quickly complete on the presentation of the financial statements and the audit requirements. We'll start with this. IAS 1 or IFRS 18. What are all the financial statements? If I want to say something as a complete set of financial statements, I need to prepare statement of, you can call it as a statement of, now IFRS 18 call it as a statement of financial performance, or you can call it as a P&L. Statement of financial position or a balance sheet. Statement of changes in equity. Statement of cash flows. And notes to accounts. In the notes to accounts, what we need to mention? First, start with the legal status, legal form plus owner details. Then move on to basis of preparation. So in the base of preparation, we'll be including 4 elements. That the books of accounts are prepared on IFRS basis. The books of accounts are showing a fair and a faithful presentation. It is prepared on going concern basis and accrual basis. So these are the 4 elements we'll mention. Then we'll be moving into the significant accounting policies. Then we'll be mentioning the critical estimates and judgments made by the company. And 5, detailed schedule of each. So which was aggregated and shown. Generally we do in the financial. So not that every expense component will be presenting. So those we will disaggregate and we'll present in the schedules. What else we'll present? Going forward, once IFRS 18 comes into place from effective from 1st of January 2027, there is a further requirement of management defined performance measure. Not mandatory, but in certain scenarios we need to present this. 7, capital disclosures. Capital disclosures, like how we are protecting the capital of the company, how the management is working towards protecting the capital of the company. Capital disclosures. So multiple elements. These how we need to present. Yeah. For the AFS, we have to present the P&L, correct? Aggregated financial position. But only thing is, in IAS 1 or IFRS 18, they gave 2 steps. Like you can prepare P&L. In the same statement, you can include the OCA also. But AFS says, I want 2 statements approach for sure. IAS 1, IFRS 18 has given 2 choices. You can prepare P&L separate statement, OCA separate statement, or you can also make a single statement. But aggregated financial statements, FTA is very clear. They want a separate statement, aggregated statement of P&L separate, aggregate statement for the other comprehensive income. Okay, so this will get split for the AFS. Statement of financial position, they want aggregated statement of financial position, Aggregated statement of changes in equity, they want us to prepare, but they don't want us to prepare the cash flow statements. Cash flow statements, aggregated cash flow statements, not required to be prepared. So likewise, we'll see the differences. So statement of financial position, yes, required. AFS required. Profit and loss required. But these two can be combined for the CFS, but in the AFS, it has to be separate. Both are required. Statement of changes in equity required. Cash flows required, but here we can ignore while preparing the AFS. Notes to accounts required in both the cases. So a detailed notes. Legal status to be mentioned for both AFS and CFS. Basis of preparation. So these are the components they want us to mention. In CFS, you may be showing that fair representation compliance statement. They want a different statement of compliance. They have given the annexure B, what and all the components it should be in the statement of compliance. So particularly, very clearly, we have to mention that this AF is prepared solely for the tax return purpose and submitting to the FTA, not for the distribution. Maybe it should also be presented, the parent entity is preparing a separate CFS for the sake of IFRS 10 or maybe commercial company law. This has to be presented. Next, for the CFS, we give the complete compliance that we are taking the 100% IFRS compliance. In case of any deviations, we have to present it over. So obviously in AFS, there are a lot of deviations from the IFRS. So they want us to give the complete. We are preparing the basis of aggregation is based on the framework given by the FTA number 1. Only the tax group members are aggregated, non-tax group members have not been considered. Sorry. And we have to give the tax group members their name, percentage of ownership, from which. So they have given like 4 components they want us to mention about the tax group and non-tax group members. So non-tax group subsidiary details also should be given. Although they are not part of the AFS, but their information has to be given. And we need to mention that we have done the line by line aggregation. We ignored the IFRS 310 adjustments. We ignored the goodwill fair. So what are all the adjustments that we have made? That 5 adjustments we have to mention clearly the basis of aggregation. And we'll talk about going concern, which is not required in AFS. Accrual basis, of course, we are following accrual, so you have to mention that. So likewise, they have given in comparison with the CFS, AFS, what are all the requirements in the AFS? This is more or less the same, like the way how we present in the CFS, all the significant accounting policies to be presented, critical adjustments to be presented, detailed schedules to be given. Management, this once going forward, maybe this is also required, or maybe they will ignore these two. For now, they are silent. Comparatives, as I was mentioning already, CFS, we might have given in 24, 23 as a comparatives, but now we are preparing a fresh. So 25 we'll prepare anyways. Do we need to give the comparatives? Yes, we require to give the comparatives, provided in 2024 also we have the tax group form. So from the first period of the tax group, we have to provide. Coming back to the audit. Same title looks the same, similar, independent auditors report. We'll continue to show the same. To whom we will address? Our general purpose audited financial statements are addressed to the shareholders or those charging with governance. Here it is more specifically meant for the management, not for the shareholder. This is meant for the FTA and the management only. So this will be addressed to the management. Opinion prepared in account, as we know, like unmodified, and all the opinions we must be giving. Here they are not very clear on that. They just want us to make sure that this is prepared in accordance with the accounting policies and FTA special purpose framework. Basis for opinion almost same. However, we also need to mention that while conducting the audit, we are also following the UAE ethical requirements. Emphasis of matter. This is mandatory. We have to very clearly mention the purpose of it, and then the deviations. Key audit matters not required, which we generally prepare for the CFS. Going concern, commenting on the going concern is not a requirement for the AFS in the audit report of the AFS. Other matters also, they are not interested in getting this. So I'll share this one also. So where it is applicable, where it's not applicable, just made a summary of it. Okay, so 12.1, shall we continue? There's only one last point we need to discuss. If you have any questions, I'm happy to take it up. Or whoever want to continue, you can continue. We'll also discuss on this point. The financial statements of the member leaving the tax group. If first tax period, no need. Yes, if it's the first tax period, but then say for example, there is a tax group which formed effective from 1st of January 2024 to 31st December 2024. Now, previously we might have done CFS, but now we are going with AFS, 1st January 24, 31st December 2025. Now the issue, I'm preparing a model, I'm using the framework of AFS and I'm preparing 2025. Do I need to prepare 2024? Instead of they saying that effective from the decision has come up 301 of 2025, 2024. In this, they have not mentioned like effective from 1st of January 2025, this will be the tax period, the first tax period. They simply mentioned here, you show all the comparatives unless this is the first tax period. If you take the standalone, for this group, FY 2025 is not the first tax period. The first tax period is 2024. So in 2025, since it is the first
Sorry
tax
to
period,
interrupt you. You are not sharing your screen.
sorry. Tax group, sorry, I'll just repeat. There is a tax group which is effective from 1st of January 2024 to it got approved in 2024 itself. So this will be considered the first tax period. So in 2025, we are bound to show the from first tax period. The exception is given only for the first tax period, but in 2025, we cannot say there is an AFS has come up now. Previously, it was CFS. So we cannot assume the 2025 as a first tax period. So in my opinion, we have no choice but to make necessary changes in 2024 in a presentable comparative way and present in both 24 and 25, both and as per the AFS framework. Just one thing, decision was only for AFS for tax group, but is it applicable for SFS of each tax group to where special adjustments are given? Further, what is the purpose of SFS? So SFS is the beginning step for the AFS. So they want to clean most of the things in SFS itself. Don't follow the IFRS 3 or IFRS 10 adjustments. Clean here itself before you come up with the AFS. And then as a tip, you can also consider any investments in non-tax group members, do it at the cost method only, because that is what the requirement for the AFS. So you better keep your SFS so much ready, or you prepare separate SFS. SFS you prepare one for your bank purpose or maybe commercial law purpose, but for the AFS you have a separate set of standard financial statements complying with all the requirement that we have discussed. No, decision was only for AFS. No, the decision they are covering ministerial decision number 301, FTA decision number 7, both are covering SFS and AFS, not only AFS. This decision is only for AFS of tax group, which should be prepared aggregate. No, sorry. SFS also they have commented how the SFS to be prepared also commented. If this SFS in while you are preparing, some IFRS or maybe some IAS says, no, you cannot prepare the SFS, then ignore that standard. You prepare the SFS in a way that the FTA decision 7 of 2025 has given. Okay, so the decision is not only for AFS, they're also taking a back step and they want us to make sure the raw material which we are using for the AFS is also clear and clean. What is the exemption for recognizing the goodwill in AFS? Yeah, that's what we have discussed. We have to ignore the goodwill in the AFS. To achieve this, we have to take the on the carrying amount basis. While you are consolidating or while you are aggregating, add at carrying amount, not at fair value. You bring in the investment in subsidiary, you bring in the equity capital. Because of this, what will happen? No non-controlling interest will be recognized. No goodwill or gain on bargain purchase will be recognized. So this is how they want us to do to avoid any goodwill, gain on bargain purchase, fair value adjustments. Okay, one last point, a quick, maybe 5 minutes I'll take. So FS of member leaving the tax group. Let's assume there is a tax group. A LLC and B LLC are the members of the tax group. Okay, they have prepared AFS. ALLC has an asset, a PPE worth of 100. This have been transferred to B LLC at 120. So in the AFS, PPE, how much? Okay, we'll also talk about depreciation. Depreciation is 0. because he already transferred the asset. The BLLC friend is claiming 10% depreciation, assuming 12 dirhams. In AFS, how much should be my PPE value and how much depreciation I can take? Can I have some answers, please? 100 and 10. Perfect. All right. Now, because of some reason, BLLC is exiting the group. BLLC is exiting the group. The SFS of BLLC still show, okay, as if I have 120 minus 12. So my carrying amount for the books is 108. Right. So this is how the exiting company standalone financials looks like. Maybe then they mention, I don't care what is your SFS looks like. You have to adopt, my dear friend, who are exiting from a tax group, BLLC, adopt the values from the AFS. So you have no choice but to show as if your PP is 100 less your accumulated depreciation of 10 and 90 is your value. Maybe your IAS 16 or IAS 40, we don't care how they want you to pension. But for me, going forward, when you file the tax returns, this is what the basis for you. Moreover, let me also tell you this. ALLC, this is investment property. ALLC is following investment property at fair value model. But BLLCs generally want to follow cost model. But then, as we have discussed, uniform accounting policies have to be followed across all the group members. So BLLC is forced to follow fair value model. Okay. Now, after coming out, it thought, okay, now I'm no more part of tax group. I'm no more required to prepare any AFS. So can I switch back my investment property instead of fair value model? I want to go with the cost model. No. The moment you are coming out of an exiting from a tax group, not just only the numbers you need to adopt, but also the accounting policies and accounting standards. Everything should be carried forward by the exiting member. So these are the things that we need to take care of. Okay, so these are the important points I'd like to discuss. We have covered almost 80% of the FTA decision number. FTA decision 7 of 2025, read with corporate tax public clarification 7007. So we are happy to take further questions on this. No questions? Okay, the previous one, what is exemption recognizing? I have mentioned the decision is only for the AFS. No, it is also for the SFS. Thank you. One thing, decision is only for. The event a member leaves, how to consider the previous year's TP impact. You mean to say, okay. One more thing. I just want to add one more point here. Just one more point I have to take you through. There, you should have asked me one more question. In this case, it makes a big difference. What we are thinking, 100 dirhams worth of asset sold to 120 dirhams. Right? So this 20 dirhams was not offered for the tax purpose because they are part of the same group. They are in the tax group. I'm sure many of you must be knowing, but however, if this tax group ceases to exist, or one of the group member, either the transferor or the transferee is exiting from the group, then there are some clawback provisions apply. How this applies? From the date of transfer, say for example, this was transferred on 1st of January 2025. If the tax group ceases to exist, or maybe one of the transfer or transfer is exiting the tax group, then you have to check, is it they are exiting within or less than 2 years or anytime after 2 years. If it is less than 2 years, then the clawback provisions apply. The transferor, our ALLC, has to admit immediately the transferor or the group, if he's in the tax group has to take this 20 as a profit. Say this was transferred in the 1st of January 2025. The company, the tax group, the one of the transfer is exiting on 1st of February 2026. So in 2026, in FY 2026, the transferor has to recognize this 20 dirhams of profit and offer it for the tax purpose. Transferee, since the first party has paid, he can continue the value, whatever the value in his SFS standard financial statements, he can enjoy 120 as the benefit. He can carry the 120 as a tax base carrying amount. Absolutely fine, because the transferor is admitting the 20. A different scenario. If the tax group is ceasing to exist, or the transferor or transferee is exiting after 2 years of the date of transaction. Now we are 2 years is counted from the date of transfer of asset or liability. In this case, the transferor no need to do anything, but the transferee, as we have discussed, his SFS should carry only 100 as the carrying amount, 100 or net of depreciation, whatever the amount. Clear? So we have previously discussed only about scenario 1, but in this scenario, in the second scenario where the tax group is ceasing within 2 years from the date of transfer, so this is how the adjustments need to be made. Okay. Thank you. Okay, thank you everyone for joining us. Over to you, Sunil.
Satyaji, and thanks everyone for joining the call. And I know like we are slightly over the planned 1 hour session, but given the significance of the requirements, it is essential that we need to take necessary time to address all the points. Once again, thanks everyone for active participation.
Yeah, we will share the recording. So this will be shared as a recording session.